So whether this is your first time hearing about gold investing or you have been buying for quite a while, this is the masterclass you need. You probably know that cash is trash and you need to hedge against inflation. Not just for a few years, but for the next 100. And this is where gold comes in, right? And in this video, you're going to learn how to approach buying gold, the types of gold that are the best to buy, and the mindset you must have, and 3 things you must watch out for that will affect the price of gold. And my aim today is to help you become an expert when buying gold. I'm going to make sure you get the most amount of gold for your dollar. And we're going to discuss getting physical gold, the paper ETFs, and most importantly, what drives the gold price. And if you're new to the game, there's one phrase you must remember. And it's a simple one. If you don't hold it, you don't own it. And that's the entire point of investing in gold. You want to be holding the physical metal first and foremost. And people buy gold because they want some money outside of the financial system and in their hands for one simple reason. You don't want any counterparty risk. When you deposit money to a bank, it becomes an asset to the bank. The money is owed to you, but it doesn't physically belong to you anymore. And that means if a bank becomes insolvent, they could reach in and take your money to save themselves. For example, back in 2013, Cyprus had a horrible financial crisis. The Cyprus bank seized a percentage of depositor savings above 100,000 euros to bail themselves out during the financial meltdown. This is what you call a bank bail-in. In fact, major depositors faced losses of 60% of their savings during a crisis. It's truly terrifying situation for anyone. And that's why people buy gold. We want to hold some money directly in our possession. It doesn't lose value over time like cash, but it is also not within the banking system. There's no counterparty risk. And the best way to start is by buying either gold bars or gold coins. And truth be told, both of them are great options to start stacking physical gold. And there are only 3 criteria that you want to remember to get the best type of coin or bar without overpaying. Now, first, you want to make sure the gold bar or coin is highly recognizable, right? So what I have here is a 1 ounce gold Canadian maple. It's a very beautiful coin, one of the most recognizable gold coins in the world. Now, the other I have is the 1 ounce gold Pam bar, right? It's a Pam bar. It's one of the most popular gold bars in the world as well. Everyone recognizes Pam gold and they trust it. Now, there are many other types of fancy gold out there. You have the American Gold Eagle here, minted in the United States. And there's also this very beautiful Chinese gold panda. But there's a big problem with these 2 coins, right? You'll be overpaying for them by quite a bit, and I'll explain why. And when it comes to buying gold, there are 2 prices you have to remember: the spot price of gold and the physical price. Now, the spot price is simple. It's the price of gold being traded on Wall Street in a futures market. We call it the spot price or the paper price of gold, but that doesn't reflect reality. And when you're buying physical gold, you want to concentrate on the physical price of gold, which is basically the spot price plus a physical premium. Now, the premium reflects the cost of digging the gold out from the ground, refining it, and turning it into coin and bar form. But this is the most important thing about physical premiums. You want to pay the least amount of premium for your gold because there's no guarantee you will get it back when you sell. And that's the price that you have to pay in order to invest in physical gold. And that's why my favorite types of gold to stack are the Canadian maples and the Pam bars. I keep things very simple. They have very low premiums and can help you minimize the premium loss when you sell, right? And this is really important because, like all other investments, you want to minimize the transaction fees. But of course, there are few others that also have low premiums, like the Gold Britannia over here. It's a beautiful coin from the United Kingdom, but those 3 are my favorites, right? And here's another tip. Buy physical gold that is 1 ounce or more. I know gold is expensive. It's above $1,800 today. But if you can get a 100-gram bar versus a 10-gram bar, do it, right? The physical premiums get smaller the bigger you go. Now, for example, a 1 ounce bar might have a premium of 4%, but a 100-gram bar's premium can drop down to only 2%. So for example, what we have here is a 50-gram bar from Perth Mint. So the premium here is anywhere from 2.5% to 3%. Compared to the 1 ounce coin, that premium's easily 4% or even 5% depending on the brand you buy. And that's quite a bit of savings, especially when you continually build your physical gold position. But whatever you do, avoid those quarter ounce gold coins or 1/10 of a gold coin. Those premiums are ridiculously high. anywhere from 10 to 15%, sometimes even 20% as well. And I also want to make a quick mention of decorative coins or bars. For example, this limited edition Year of the Rabbit Gold bar from Pam has a premium of 8 to 9%. That is very high. Yes, it looks very beautiful, but I'm buying this to collect and not really as an investment. So you have to be clear about that when you buy gold. If you're mainly an investor, avoid things like this and stay simple. Focus on the premium savings. And a very big question that comes up is why gold and not silver? Should I buy both gold and silver? Now, let me disclose that I hold quite a bit of silver. I've been buying physical silver for almost a decade now, but I still recommend people start out with gold if they're new to precious metals. Now, silver is not a primary monetary metal, it is more of an industrial metal. In 2021, more than 70% went into industrial use and not investment demand. This is a very important point that many gold and silver stackers forget because the fundamentals for both are very different. Silver is correlated to the health of the economy. If a recession hits, we could see silver crash while gold stays resilient and could even appreciate. Now, if we take a look at the performance of gold and silver during the big stock market crashes, we can see something very interesting. On average, silver fell by 16.4%, while gold actually held strong and appreciated by 6.5%. Sure, both were more resilient than equities, but silver still collapsed together with the rest of the market. They are very different metals. The drivers are very different. What drives the price of gold doesn't always affect the price of silver. And there's another point you must know. Physical silver premiums are disgustingly high compared to gold. An ounce of physical gold might have a premium of 3 to 4%, but an ounce of silver could have a premium of 20 or even 30% depending on the type of brand you get. And when you sell it back to dealers, you lose the bulk of the premium. So you need to understand the reality of investing in silver. You will pay more upfront and potentially lose more when you sell. Now, the upside for silver is much more volatile than gold. So if you time the market well, or if there are supply and demand shocks, you could make a whole lot more with silver. But let's focus just on gold for this video. So what drives the gold price? I think this is the most important part of our discussion because you need to know what will affect your investment. There are a lot of factors that can swing gold prices around, and they range from geopolitics all the way to supply and demand. But I want us to understand the concept of financial trust. Is the financial trust of money being destroyed? This is the most important question you have to ask yourself when it comes to gold, because it will affect whether money flows into or out of gold. As financial trust goes down, the demand for gold flies up. And let's go through what's destroying the financial trust of money. And the first is simple, the debasement of global currencies, which is happening everywhere. But you always want to focus first on the US dollar because gold is priced in dollars. And that means if the supply of dollars suddenly increase, the price of gold will be affected. For example, over the last 2 decades, we faced 2 severe recessions, and this prompted the Federal Reserve to print up trillions of dollars to prop up the economy. First in 2008, then in 2020, bringing the balance sheet from less than $1 trillion to nearly $9 trillion in under 15 years. And that's why we can see this incredible rise in the gold price, taking it from $700 an ounce to new all-time highs hitting over $2,000. So every time countries start to debase their currencies by printing a lot of money, this reduces the financial trust in money and people start to flock to gold. They know their fiat currencies are being mismanaged and they move towards a true store of value. Now, the second thing is destroying financial trust. It's the huge amount of deficit spending countries are embarking on. And this is essentially spending tomorrow's wealth today. And as you can tell, it is very inflationary. For example, in 2022, the US government spent $6.27 trillion, but only $4.9 trillion came from revenues such as taxes. The rest came from deficit spending, which means issuing bonds to raise money. And a big portion of the money comes from the Federal Reserve through debt monetization, which is basically the Treasury issuing bonds to the Fed, which then prints up tons of cash for the government to use. And this expands the money supply, and not all the money is used correctly. There's a lot of wasteful spending that doesn't increase the supply of goods and services, and this causes even more inflation. It dilutes the purchasing power of the dollar, and that's why gold rises in price. It's not really because gold is rising in value, it's because the dollar is worth less and less. In fact, over the last 100 years, the dollar has lost 97% of its purchasing power, and this isn't gonna stop. We can see that over the past 20 years, there's been no fiscal responsibility. more money is being borrowed and the deficit is growing. It went from a budget surplus in 2001 to huge deficits of over $3 trillion at one point, and this isn't going to stop anytime soon. And the third driver of the gold price is a big one. It's a new one, and that is geopolitical chaos such as war and sanctions. Now, every time there's a war, it tends to be very inflationary because you're simply printing money to blow up stuff, right? You don't increase the production of commodities. In fact, you are consuming oil and industrial metals to construct the war machine. And this decreases supply and causes inflation in everything. And that's why when there's geopolitical instability like the conflict in Russia and Ukraine, the price of gold tends to go up, right? It is accounting for all the chaos and inflation that's happening. But in 2022, we also saw a black swan event that tore apart the trust of money. Remember that everything filters back to whether conventional idea of money is working or not. And I'm referring to not just the currencies, but the entire structure of the financial system. And when the United States and their allies froze Russian assets, it sent shockwaves across the world. Suddenly, the wealth of nations can be confiscated, and this destroys a lot of trust in the financial system, which is predominantly Western-centric. And that reminded the world that financial assets such as US Treasury bonds could be frozen by governments and aren't truly safe. And this freaked out many central banks and countries such as China, which began dumping their holdings of US Treasuries and started moving more into gold. And in 2022, central banks added over 1,100 tons of gold into their reserves, a 55-year high. They know that gold holds no counterparty risk and is a long-term store of value, so they piled into it, especially in 2022 when the sanctions started. We also have China officially buying gold month after month, which is big news. And in a paper by the IMF, they also acknowledge just how the risk of sanctions is pushing central banks to rush more for gold. So this is a very important development that you need to track as well. Central banks, they are the biggest buyers of physical gold, they are the biggest stackers, and what they do can move the market. If the big financial nations of the world keep freezing assets for whatever reason, it lowers the trust of money. And when the world loses trust in conventional money, right, they move more towards gold as an asset you can hold without having to trust the counterparty on the other side. But what about ETFs or paper gold? Is there a point in buying them? Now, there's a lot of advice circulating around telling you to avoid ETFs like the plague. And I agree that physical gold is the best way to go. But ETFs are still very useful, and I personally buy them as well. Now, if you're new to ETFs, these are funds like the GLD Gold Shares or the Sprott Physical Gold Trust that gets you exposure to the price of gold. You are buying shares of a fund that tracks the price of gold. So if the price of gold goes up or down, the fund will reflect that in their price. So there are two reasons why you might want to use ETFs to get exposure to gold, because holding the physical metal might not be possible for everyone out there. And the first is if you can't afford to buy a full ounce of gold, or if you want to avoid paying the physical premiums. Now, there isn't much point in buying quarter ounce coins or 10-gram bars. The premium you pay doesn't make sense. And if I had to choose between a 10% physical premium or 0.4% ETF management fee a year, I'd choose the ETF. I'll use the ETF to build my position until it goes above an ounce or more, and then I'll sell out of the ETF and buy the physical bar later on. Now, I've done this multiple times and it works like a charm, especially if the price of gold keeps rising. And the second reason is to quickly sell out of your gold position. Now I can preach why physical gold is the best, but there are some of you out there who just sees gold as a trade, and that is fine. If your aim is to actively manage your portfolio, ETFs are the best way to get in and out of gold quickly. It's just like buying or selling a stock. You can execute your order instantly. So you gotta understand what's most important to you. And that brings us to the million-dollar question. When should you exit your gold position? When is a good time to sell your gold? And this is a very personal question that you have to answer for yourselves. But I'll share one chart that I like to refer to, which is the S&P to gold ratio. Now, there are many times when gold is overpriced, and there are other times when stocks are underpriced. For example, back in 2010 to 2012, it would take you less than an ounce of gold to buy a single share of the S&P 500. But today, you will need over 2 ounces of gold to buy the same share. and that tells us that shares might be currently overpriced versus gold. So if you have the holding power, you can wait until this ratio narrows before selling off your gold for income producing stocks. But we also have to be realistic. We don't know when this will happen, as sometimes we have to sell our gold if there's a good opportunity out there. And one great example is real estate. Now, gold is great, but its biggest weakness is that it doesn't produce any income. It pays no dividends, so you can't live off it. Gold's purpose is to simply store value. So let's say you find a great piece of real estate that pays you 6% rental yield or more. It's worth considering liquidating your gold to buy the property, because we know that inflation will still be persistent, and just like gold, the home will keep its value over the long term if you do your homework right. And that's why having some gold for diversification is great. It allows you to stay liquid while protecting your purchasing power. And this concludes our masterclass. Gold is all about storing your wealth outside of the financial system and leaving a real legacy for generations to come. And let me end this with a simple scenario. Let's say your grandparents had $3,500 back in 1971 and they left the cash intact for you. You would have a small stack of cash, but we both know that $3,500 today can't even buy the wheels on a car. But if they converted that money to 100 gold coins, you would have almost $200,000 today. That is a handsome down payment on a new home or even a Lambo. And as we move towards the future of digital money, CBDCs, I think holding some physical gold is a wise move that everyone should consider. So let me know what you think in the comments below. Are you buying physical gold today? Let me know. Stay safe. Be sure to smash the like button and subscribe as we protect our wealth together.